In these uncertain economic times, a truth once deemed unimaginable is gaining traction. The Federal Reserve may not be done raising interest rates after all. This startling prospect, far from the rate cut consensus that dominated forecasts mere months ago, underscores a profound shift in market sentiment. A realignment, if you will, of how we envision the path ahead for monetary policy and the nation's financial fortunes. Let's take a step back. For much of this year, the overwhelming expectation among traders was that the Fed would continue easing the economic brakes, implementing as many as 6 or 7 further rate cuts by year's end. A soothing balm, they believed, to nurture the recovery and steer us toward the safe harbors of economic tranquility. But the currents have changed. The once placid stream of economic data has become a raging river of conflicting signals. Higher than anticipated inflation readings, month after scorching month, have upended assumptions and forced a reassessment. The whispers of dissent have swelled into a growing chorus entertaining an idea that was unthinkable at the dawn of 2024. The Fed's next move could be to raise rates yet again. The evidence is in the markets themselves. Options trading now ascribes roughly a 1 in 5 probability to another Fed rate hike within the next 12 months. A far cry from the single-digit long shots priced in at the start of the year. The inexorable march higher in market-implied rate expectations has reverberated through the canyons of Wall Street, whipsawing bond yields and snapping the stock market's fragile upward momentum. No longer is the Fed on a preordained path of rate cuts. As Richard Clarida, the keen economic mind at PIMCO and former vice chair of the Federal Reserve, plainly stated, at some point, if the data continues to disappoint, then I think the Fed will have to start re-engaging on hikes. An unsettling thought, to be sure, but one that cannot be dismissed out of hand. For if core inflation proves stubbornly resistant, climbing back above the 3% threshold, even the Fed's current policy stance of an extended holding pattern may be untenable. Already, esteemed voices like that of former Treasury Secretary Lawrence Summers have raised the alarm about the risks of complacency. Greg Peters of PIMCO encapsulated the shifting mindset with prudent even-handedness. I think it's completely appropriate to factor a rate increase in. I feel much better about the market pricing that in, versus the start of this year when it was just cuts in extremis. This is no idle chatter from the investors who command the levers of capital. Quantitative models analyzing options data confirm the sea change, with estimates of the probability of a rate hike over the next year ranging from 20% to nearly 30% across various analyses. Hardly overwhelming odds, but a far cry from the long-shot scenarios of seasons past. The unifying thread is uncertainty that most human of economic catalysts. As Benson Durham of Piper Sandler remarked, there is loads and loads of uncertainty. In his estimation, while rate cuts remain plausible, with up to 8 quarter-point reductions arguably priced into options over the next 12 months, the probability of policy tightening can no longer be dismissed. I can also see them adding another dollop, he added. And therein lies the crux. Amidst the cacophony of conflicting data points, the crosscurrents of economic forces, and the shifting sands of market expectations, one truth emerges with clarity: uncertainty reigns supreme. The Fed's path forward is no longer the well-trodden trail we once envisioned. It is a road into the unknown, fraught with forks and twists, each turn holding profound implications for the financial fortunes of us all, ordinary Americans striving to make sense of it all, and the professional investment ranks who grease the wheels of capital flows. How this journey unfolds will be a tale for the ages, one I anticipate recounting in many a chronicle to come. For this is a pivotal juncture where economic ideology collides with pragmatic reality, where the surest of policy convictions are subjected to the crucible of real-world developments. In such times of upheaval and transition, open minds must prevail over doctrinaire thinking. It is a moment tailor-made for the humble reassessment of once steadfast views. The Fed's own policymakers seem to be heeding that clarion call, as New York Fed President John Williams's recent comments attest. If the data are telling us that we would need higher interest rates to achieve our goals, then we would obviously want to do that. This reassessment of the Fed's likely course and the nation's economic destiny is more than an idle parlor game for the privileged investment elite. No. Its ramifications reverberate across sectors, across income strata, across the very sinews that bind our financial reality. For if there is one constant in the march of economic forces, it is that their impacts are democratically distributed from the grandest estates to the humblest of residences. So gird yourselves, my friends. Whether your purview is the rarefied climate of finance or the more terrestrial realm of stretching a paycheck's buying power, tumult lies ahead. The economic winds are shifting, the ground beneath our feet is no longer as solid as it once seemed. In times like these, the wise embrace a stance of watchful risk awareness while fortifying their philosophical and practical foundations. For in an era of growing economic uncertainty, the only true path to safety and prosperity lies in the timeless wisdom, hope for the best, but prepare for the worst.